Namaskar, this is Akhilesh Bhargava. Welcome to Tit-Bits on Business and Finance with me. The scammy DHFL has borrowed, defaulted and gobbled up bank loans to the tune of 95,000 crores. It has now been admitted to the NCLT for either resolution, settlement of the case, or if that is not possible, for liquidation of the company. In the meanwhile, the bankers seem to be in a very strange and unusual hurry in order to get a buyer for DHFL, even if that means that banks are going to take a huge haircut on the loans that they've given to DHFL. Getting a buyer is good, but why are they in a hurry to somehow settle it, even if it means a huge haircut? The promoter of the company, in the meanwhile, is in jail, and he's in jail for a massive fraud that he has committed in the company, and he remains under investigation by all kinds of criminal and investigation agencies of India. The frauds that have taken place in DHFL, according to us, have been because of negligence and collusion by the bankers in particular. Of course, the promoter was dubious, but it was not possible unless the bankers very recklessly gave loans and let them be misused. They seem to be in a hurry to now settle the case, according to us, perhaps thinking that in case the case gets settled, in case they get a buyer, they will be able to close the matter such that maybe the guilty bankers are able to avoid the same fate as that of Kapil Wadhwan, which is being jailed for their crimes. Last week, the bankers received the best possible offer for takeover of the company, and that was 20,000 crores. At 20,000 crores, it means that the bankers would write off at least 75,000 crores of the bank loans. It was that measly an offer. And now suddenly, in a week's time, this offer has been improved to 33,000 crores. It is good that the offer has been improved, but what is it that happened in a week's time that it got improved so drastically? To us, DHFL is a classic case of bad loans given by bad banks to a bad borrower with a bad end result, a huge NPA and a potential gigantic write-off of the loans by the banks. And this does not happen overnight. It has happened over the years. Over the years, the banks were blindly lending money to DHFL, not bothering to check what was happening. And while the banks were blindly lending, the DHFL promoters were merrily siphoning off the funds from the company. No wonder today, the personal assets of Kapil Wadhwan, the promoter of DHFL, exceed 44,000 crores. They of course would have got built up because of this kind of a massive siphoning of money. To us, it is again a classic case of fraudulent waste of public money. DHFL is not alone in this game. Many other cases, including Jet Airways, Videocon, etc., are in the same situation. Big money is given, siphoned away, big haircuts imminent, and bankers seem to be in a hurry to close the case for reasons best known to them, willing to give massive haircuts to the defaulting borrowers. And it is on account of these kind of bad banking practices, these kind of bad loans given by the public sector banks, that today they are loaded with a mountain of bad loans, a mountain of NPAs because of these scammy lending practices. Viral Acharya, the outspoken, plain-speaking, hard-hitting former Deputy Governor of Reserve Bank of India, in a recent speech says that the entire public sector banks of India are one giant bad bank. These banks together and collectively, according to him, have gobbled up over $100 billion, which is over 7.5 lakh crores of taxpayer funds in the last 10 years without giving any results. In other words, all that money went bad. He says that this has taken place because of the sab chalta hai attitude in public sector banks. No one cares there, according to him. While he says that the figure is $100 billion, we think that it is much higher than that. And this $100 billion that he says is primarily represented by the recapitalization of banks that continuously takes place because of capital loss by them on account of NPAs which do not get recovered. Viral Acharya further says that this bad banking, these bad banks continue to operate because there is no governance in public sector banks. In his opinion, the government has failed in its capacity as the owner of the public sector banks, and that is very evident from the fact that boards have not been empowered to run public sector banks. Some kind of a remote control continues to function from Delhi. According to Mr. Acharya, there is no discipline imposed even by the shareholders on the management of these banks, and the failure of management, the failure of governance continues. It is because of this, he says, that banks are not earnest about disclosing the balance sheet quality. They continue to hide the NPAs such that, on an average, it takes over 4 years' time to recognize an NPA, to recognize a dud loan. It should have been recognized much earlier, but it gets pulled on to that kind of a time. He further laments that the RBI tried to clean up these banks. The RBI tried to lift up the level quality of regulation of these banks, but he said that was not appreciated, and that he says is a monumental tragedy. Viral Acharya's speech may be scathing and hard-hitting, but we think that he is not wrong on the facts. There is a lot of merit in what he says. The fact is that public sector banks are already loaded with the NPAs, with the dud loans, and as per the Reserve Bank's own estimate, they could double by March 2021. They are already in an unsustainable, unviable level. It's going to only worsen, and that's because the COVID pandemic has affected borrowers even further. The bankers today are reluctant to recognize NPAs, and because of this failure to segregate the bad loans out of the good loans, the bad loans have cast a shadow on the entire loan portfolio of banks such that bankers today are risk averse and they are reluctant lenders, which is the main business that they are supposed to do. It is this rising portfolio of bad loans of public sector banks which has today affected lending by them at a time when the economy badly needs bank loans. Due to this failure, due to the reluctance of the government and the management of public sector banks to carve out the bad loan portfolio from the total loan portfolio, the bad ones have in effect subsumed the entire loan portfolio of banks, and due to that, bankers are a scared lot. They have not been very willing to lend, and that shows on the growth of the bank credit in India's economy of late. The entire banks, because of these, have become bad banks. We are talking about public sector banks. The need of the hour, if we take a cue from Dr. Viral Acharya's speech, is to carve out the bad loans out of the total loan portfolio. And if that is done, the chances that the NPA crisis may get resolved certainly become better. That, if we take, is one conclusion that comes out from Dr. Viral Acharya's speech. Why is it necessary to segregate the bad loans today out of the good loans? There are various reasons. The first is the bad loans continue to be mixed in the total loan portfolio of the banks. Unless we do not identify all of them and carve them out, we are not going to be able to define the total size of the NPA problem. Until that is not defined, till that is not known, two things happen. We will not be able to initiate solutions, and in the meanwhile, because of this infection of the entire loan portfolio, by letting the bad loans be into it, the bankers continue to get a chance to window dress their balance sheets. The second, as we have said, is the bad loans subsume the entire loan portfolio of banks. By doing that, you never come to know the true value of the bank. Valuation of the bank is not clear, and the norm is, or the notion is, that the bank is a bad bank, as Dr. Viral Acharya points out. And because of this, fundraising is not easy by banks. And of course, shareholders continue to suffer. They do not get the right valuation for the shares that they own in the banks. The third fact is that bad loans are very different from good loans. You need a very specialized experience and expertise in order to manage the bad loans. The ARCs were supposed to help clean the system. They have failed to do that. The need of the hour is to carve them out, put them into some kind of a specialized institution, and put specialized expertise at work in order to resolve the issue. Therefore, it becomes imperative to carve out these bank loans. Further, if we were to do that, then there will be a healthy portfolio of loans left with the banks, and the banks will be able to focus on what their normal business is, which is borrowing and lending. Today, they have been just borrowing by way of deposits, etc. The lending has been suffering. If we give them a clean portfolio, if we give them a portfolio which is very clearly defined, take out the big number of bad loans, it will be much easier for them. And finally, according to us, when bad loans remain hidden in the good ones, then accountability suffers. While they remain hidden, it is difficult to point out the guilty bankers, the guilty borrowers with ease. You are not able to point out the delinquent ones, and in the process, the entire system suffers. After all, the delinquent ones, the corrupt ones on both sides of the table must be punished in case we want to cure the system. And we want to avoid the likes of Dr. Viral Acharya saying that public sector banks in India today are one large bad bank. This is Akhilesh Bhargava signing off till we meet again. Namaskar.
Now be the first to know about the latest updates on our new news app. Go on your Android or iOS, search for HW News Network. Download our app, choose the language you prefer to get updates in, and be up to date with the latest news.
If you like this video, please share it, and we would love to hear your comments in the comments section down here. Also, please do like our Facebook page and follow us on Twitter to get minute-to-minute news updates. For more such shows and videos, subscribe to our YouTube channel.